technicals, the fundamentals is what Ted Rossman's here to help us break down, senior industry analyst at bankrate.com. Ted, good to have you with us this Thursday morning. I'm sorry. Let's start with the spike, the move up this week in rates following some stronger than expected data. It's got investors a bit concerned.
That's right. Yeah, we're talking higher for longer, or really the Fed's talking higher for longer, and that has major ripple effects. You were talking about the 10-year Treasury a moment ago. That's really the benchmark for 30-year mortgage rates because a lot of people move or refinance within 10 years. So that really becomes the baseline, and then issuers add a profit margin or lenders add a profit margin, of course. We're seeing the average 30-year fixed rate mortgage a little bit over 7% right now. And we could be stuck in that low sevens, maybe even mid sevens for the next several months, maybe high sixes. But, we had thought previously that the average 30-year fixed rate mortgage could drop to around 6% by the end of the year. And I feel like those hopes are being dashed by the fact that inflation's come in hotter than expected. The Fed's planning on keeping rates higher. That has major effects on the housing market. This is a very rate sensitive area, and it's just really tough, especially for those first-time buyers, but also for move-up buyers who maybe they have a 3 or 4% rate and they don't want to trade it for a 7% rate. So I think higher for longer really hurts the housing market more than anything.
Yeah, we're seeing yields, I feel like, at the epicenter of many of these discussions, and the ripple effect is definitely widespread. Let's talk a little bit about how it's kind of tough to tell which came first this week in terms of the catalyst, right? You had unease about the PCE leading into the week, out of the holiday weekend. We started off with Kashgari's comment about, not taking rate hikes off the table. Adding to that were some of the other contributing factors this week. I feel like we're in kind of a chicken and egg scenario, which came first, but ultimately it left the markets a little bit scrambled.
The important result is that higher for longer seems to be ruling the day here. And there's a thought that maybe we don't get any rate cuts this year, or maybe there's just one quarter point cut towards the end of the year. That seems to be increasingly likely. It's kind of a coin flip if that happens in September, or maybe it's more likely by December. But you have to think that 5 or 6 months ago, as we turned into 2024, the market was hoping for 6 or 7 quarter point cuts this year. Now, the Fed was talking more like 3, but the point is that rates are staying a lot higher for a lot longer than people thought. And it seems very unlikely that we'll get a rate move this summer. Even that September meeting, I think, is very much up in the air. Some think that's already getting a little too close to the election to make a rate cut. Maybe we just get 1 quarter point cut in December. I mean, that's not going to make much of a difference, I would say, on the consumer borrowing side. But also, I think markets are having to digest a much higher rate environment than initially planned.
We've been talking about that, right? With rate cuts off the table, it seems like investors were able to focus on the positive, discount the negative, and that was earnings. As some of the big tech names that we saw kind of carrying the weight for the market. Even Fed Chair Jerome Powell kind of gaslighting this recently after that concerning PPI data print, I feel like kind of accelerated things a bit to the upside here. Now just off those all-time highs as investors are more kind of taking into consideration some of the negatives and not necessarily discounting them as they focus on the positive. But one of the negatives this week also, can you talk to us a little bit about how the auctions, there were some concerns related to deficit funding here in the U.S.?
Yeah, that is something that some people are pointing to. And that's another sort of chicken or the egg sort of thing, that inflation is feeding into some of this, but the situation with bonds and auctions could maybe be further fueling inflation, or at least keeping rates higher. So, these are things that people are concerned about. From a consumer standpoint, I think that there continues to be an important disconnect because a lot of the economic fundamentals are pretty good. We talk about the longest stretch of sub 4% unemployment since the late 60s. We could talk about GDP growth that, while it was a bit lower in the first quarter, was very solid last year. Looks like it's rebounding here in the second quarter. The Atlanta Fed tracker, which sometimes runs a little hot, but still they're talking about current quarter GDP maybe around 3.5%. Sometimes I tell people like, oh, the economy's in pretty good shape. And they say, well, I'm not feeling it. And that's the important thing, is that at the individual level, inflation is still too high. There's a cumulative effect of about 20%, where even as inflation moderates, prices aren't really going down. So your rent is up, your grocery bill's up, your gas bill's up. This is an important topic as we head towards the election because people are not feeling good about the economy right now, largely because higher prices are masking whatever wage gains they're making.
Not feeling good about the economy, but I read in your notes that you think that the economy is in probably better shape than most people realize, and maybe that's what's keeping the market at these upper levels.
The economy is in solid shape if you look at things like the unemployment numbers and consumer spending. I mean, yes, it's moderated a bit, but that was also part of the plan. That's another important clarification is that the Fed's trying to slow things down. So they would actually cheer a little bit of a decline in consumer spending, maybe a little bit of a rise in the unemployment rate. The tricky balance is that they don't want consumer spending to fall off a cliff, of course, because that powers so much of the economy. They don't want unemployment to spike too much, but it does seem like some moderation is needed. And they're actually getting it. Some of the recent data on jobs and consumer spending has actually come in pretty disinflationary, I would say. It's helped also that gas prices have backed off a little bit over the past month or two. Now, maybe more recent data suggests that they maybe start to go up a little bit. They often go up in the summer. That's a very price sensitive area you can't miss when you drive around and you see that gas prices are higher. The biggest drivers of inflation, though, continue to be housing, which has been remarkably stubborn, and also non-housing services, things like car insurance and medical bills.
All right. Hey, a solid look at yields on the move higher and a conversation, I guess, that we could have you back for in the future. Hopefully, for those that have been dealing with these pressures, ultimately they come off a bit. And for some of those mortgage holders that are looking to make some changes, as you pointed to as well, they're kind of feeling the pinch at these levels above 7%, right? So we'll continue this discussion in the future. Ted, appreciate you joining us, sharing part of your Thursday morning with us. Ted Rossman, Senior Industry Analyst at Bankrate.com.